What is up, traders? What's up, tycoons? Super excited for today's video. Did you guys know that on a total return basis, we're almost back to all-time highs? What we're looking at on this chart is going to be the QQQ, the Dow Jones Industrial ETF, DIA, and as well as the S&P 500 ETF, the SPY. So, does this mean that the seasonality is going to play out and we're going to get new highs in the market as the seasonality suggests? You can see here that the S&P 500 ETF, the SPY, has been following along pretty well with the seasonality projections, and it suggests that we're going to get new highs into December, right? We're very, very close to there as we just took a look. But as always, the content provided on this channel is for informational and educational purposes only and is not meant to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer and we'll go ahead and get into the video. I do want to remind you guys I started a completely free newsletter, Investment Intelligence, giving out free finance content and free trade ideas directly to your inbox. Okay, I try to sprinkle in 1 to 2 trade ideas a week. Right. And you can see basically what it looks like here. We go over the chart conditions, the chart patterns, different things we're looking at, and, give you guys the chart itself as well. And a lot of these trades have played out very, very well. Okay. If you take a look, this is another one here on Stanley Black & Decker, highlighting the rising wedge, and you can see how that rising wedge played out, came down and hit those price targets there exactly. So if you're fans of free trade ideas and you want those sent directly to your inbox, feel free to sign up for that newsletter, completely free to you. All right. And if you want access to all of the different trade ideas, Carnival was one of the really great trade ideas we had recently. There's, IWM went up 6% in one day after we got into IWM. So, if you want access to all of the different trade ideas, you can join the Investment Intelligence Discord. Okay, it's $10 a month, just a few dollars a week. Very affordable, and that is where you can get access to all of the different stocks, charts, cryptos, commodities, bonds, everything like that I'm looking at. Now, we'll get back into the data, starting off here with retail sales. The inflation-adjusted picture for retail sales shows that consumers are not retrenching, but instead being more judicious with their dollars. Now, retail sales has been a big surprise, okay, in the economy here lately. And this is one of the major factors that bulls are saying and, using to really push up the market right now. Okay, as we just took a look at that chart, the three major indices right here, three major indice ETFs are very close to back to their all-time highs. And we hear nothing but bearishness from all of the bears, right? And things about a recession, things about the economy. We're going to dive into that a little bit more in today's video, but I want to give you guys a little bit of both sides. Now, when you take a look at smart money versus dumb money, the gap between U.S. individual investors' allocation to equities and the fund manager survey investors is now the narrowest since February of 2022. So we talked about, before how these two things are basically, had a huge divergence, right? And that they normally snap back together and end up trading very closely correlated to one each other. And so we're starting to see these, snap back together now finally. And I just think that that's pretty interesting. We're basically seeing, the smart money and the dumb money, quote unquote, on both of those, starting to have a little bit more of the same thesis and same view of the market. Now, when you look at the market versus the Fed, there have been 7 attempts by the market to take yields down in response to a Fed pivot in the last 2 years. All of the first 6 proved not to be pivotal. So this is the most recent one, right? And, the blue bar chart here is essentially the Fed funds rate, right? And, recently we did get some weak data, all right? CPI, PPI, there's been some other things, in the labor market as well. Okay, that the Fed, things that the Fed would want to see. But what you have to keep in mind with the yields dropping and things like TLT going up is overall that doesn't change the dynamic that we've been facing, which is mostly just a supply and demand issue. Okay, the Fed is not doing quantitative easing anymore. They're doing quantitative tightening. Japan and China have been selling and become, sellers of U.S. Treasuries. Those two countries were the biggest and largest buyers of U.S. Treasuries and holders of U.S. Treasuries. So really, you have the three, most important factors when it comes to the Treasury market, essentially absent from there, right? And on top of that, you had massive short positioning. So what's very possible is that the seventh time could be the time where it's actually pivotal, all right? And we could see yields actually continue to go down right here, all right? The white line is the 10-year treasury yield. We just want to be cautious of these dips, right? These dips, and then where the trend actually continues back up higher. We see the dip here and then the trend continues higher, dip here, trend continues higher, dip, and then trend continues higher. And, that's been a story that we've seen for a long time. So you don't necessarily want to get trapped right here. You just want to be aware of the current situation. And if this is actually going to be pivotal, then, most likely we will see 10 years fall down. Okay, maybe this is lucky number 7, but with a 6 out of 7 track record, of failing, that's not really the best track record, right? So you want to keep that in mind. Now, both initial jobless claims increased by more than expected, rising to 231K and 1.865 million. The former is around a 3-month high, while the latter is the highest since late 2021. So when it comes to a recession, unemployment, jobless claims, things like this is something that you want to be, paying a lot of attention to. Now, the Fed wants to see this stuff rise and head in an uptrend. So this is what the Fed is looking for. And typically, as you head into a recession, the Fed is going to be cutting rates, and that's going to result in, treasury yields going down. So again, maybe, this is that time where, we do actually get the pivotal drop in 10-year treasury yields. So seeing this continue to rise, okay, and if we start seeing unemployment continuing to rise, that's going to be a little bit more leading into a recession, right? And signs of a recession possibly coming. We have WTI crude oil at the lowest since July 7th. People are saying, is this a recession warning, right? Now, they were saying the same thing when oil was skyrocketing to the upside. Now that it's pulling back and it's at very low levels, again, people are also saying, hey, this could be a warning of a recession. Now, when you look at the wage tracker, if posted wages continue to slow down at roughly the rate they have for the past 3 months, the Indeed wage tracker will turn to its pre-pandemic pace before the middle of next year. Now, this is stuff that's important because of inflation, right? And so, if inflation, has been on a downtrend here as well, okay, it's not going away. Prices of things are still going higher, but ultimately, we want to see as one of the people in the economy, right, as one of the people and civilians in the US economy, if inflation is outpacing our wage growth, that's not a good sign for us, right? And that's not a good look for us. And then we're actually making less money, even if we are getting raises or even if we're making more money. If inflation is higher than the wage growth, that's not a good look either, and that's going to be weakening for the consumer. The Goldman Sachs Financial Conditions Index recently had its most dramatic drop, right? The easing of negative 23 basis points was historic. It ranks as the 30th biggest one-day easing event going back to 1990. And so when we go back to that chart of 6 of the 7 times that they looked for a change in the US 10-year treasury yield, this was a really big jump right here, and this could really be basically narrating and telling us that there is a huge shift coming, and that maybe something really did pivot in the markets, and that maybe treasury yields are actually about to start declining. Right. And then what's really interesting too, if you look at value versus growth, value is rising roughly in line with the US real yields across the world. Only the US is bucking the trend. And so what we have here is the Euro area in orange, we have UK in purple. Okay, we have US here in this gray color. And you can see since ChatGPT has went mainstream, right? Growth versus or value versus growth has been in a decline. Okay. And it's really been the Magnificent Seven stocks, growth stocks, tech stocks, that can benefit from AI that have really been leading the way. And that's why you're seeing this value versus growth go down. But when you look at other markets in the world, okay, you can see Japan, value versus growth is outpacing, Euro area, UK. And then in red, you have the US 10-year tips, which is Treasury inflation protected securities. Okay, oftentimes people refer to these as real yields, and we can see that all of those have been in a nice incline here. So value versus growth does work in certain markets, but it's not working in the US, right? And that's mostly because it's AI dominated. That is, the US equity market is AI dominated. Now that's pretty much it for today's video. Just wanted to go over some nice info, some nice data that I found, share it with you guys. I've got a really good video coming very soon. I'm probably going to drop it later tonight on the melt up situation, some seasonality, and whether or not the stock market is going to actually continue melting up higher from here and just slowly grinding up, or whether or not we're going to actually see some type of huge drop in the market. Don't forget to sign up for that newsletter, Investment Intelligence, giving out those free trade ideas, free valuable finance content. And if you want to, you can also join the Discord. All right, the Investment Intelligence Discord. There's links in the description for both of those.